Hi, this is Chris from Kimble Charting Solutions. Today's January the 6th, 2014. Today I want to discuss in just a few slides the messages from the real estate complex, the shoebox indicator, and high yield mutual funds. I'm sorry about my voice right now. I'm suffering from a cold. We'll start off today's presentation by focusing on IYR against the S&P 500, highlighting the year 2007. IYR happened to peak 8 months ahead of the S&P in 2007. Was that enough of a signal to make major portfolio shifts? And we all know the answer would be no. But was there other divergences going on in 2007 besides IYR? The following slides will discuss what was taking place then, and we will compare it to now. This slide reflects that IYR and the shoebox indicator were both diverging against the S&P 500 as it was moving higher in the early part of 2007. In looking at the high yield fund complex, looking at the PIMCO fund specifically, you'll notice that for a couple of calendar years it was moving sideways and it started reflecting some early weakness itself in early 2007. The take from the last slide was divergences. Divergences in the shoebox indicator, high yields, and real estate in early 2007 as the S&P 500 was moving higher. So we would look at those same three today. What would we find? Well, we would see some weakness in IYR, peaked in May, shoebox peaked in May, a divergence against the S&P 500, and also some relative weakness in the same PIMCO high yield fund as of the beginning of 2014. So why did I start off the slideshow comparing IYR to the S&P? The reason that it could be significant is in the first slide we discussed that IYR peaked 8 months before the S&P did back in 2007. IYR peaked in May of this past year in 2013. If it was to have a similar impact, the 8-month lag, in other words, where the S&P 500 would peak, if we had a similar occurrence to 2007, would be this month, January of 2014. Was it just that simple that we can look at one ETF and make our major allocation decisions? I don't believe so, but as we all know, this is a very important sector to the overall economy. This slide highlights in the upper left the New York Stock Exchange Index and its advanced decline line. If you'll notice in the late 90s, early 2000s, we had a big divergence in the advanced decline line against the NYSE, reflecting what was going to happen in the years to come. Then in 2007, which we've been highlighting in today's discussion, we also saw a divergence in the advanced decline line was diverging against the NYSE. In the right-hand chart, you'll see at the current time, as the NYSE is heading higher, the advanced decline line is reaching all-time highs. So this is the one component that we see a difference in comparing 2007. I'm not bringing up 2007 suggesting that we had a 50% decline then and we'll see one now. That's not the point of today's discussion. Is we're looking for divergences, little cracks in the foundation where a decline could start. I have no idea of the magnitude, but we wanted to look for commonalities of prior significant declines to today. Today's video was to discuss the current conditions of the real estate complex, the shoebox indicator, and high yields at the beginning of 2014. In looking back, it reflected that the real estate peaked 8 months ahead of the SPY in 2007. That alone is not enough to make major portfolio allocation changes, but at that time the shoebox and high yields were also reflecting relative weakness, giving some people some confidence to make some portfolio adjustments. Real estate peaked 8 months ago in May of 2013. The shoebox and high yields also peaked at that same time, and at this time they're reflecting relative weakness similar to 2007 at this time. The advanced decline line in 2007 also was diverging, reflecting relative weakness. The one thing that is different so far in 2014 is that the NYSE advanced decline line is at all-time highs. So we all know now that IYR was a leading indicator in 2007 by roughly 8 months. IYR peaked in May. An 8-month lag would suggest that the SPY, if we had a similar repeat, would peak in January of this year. We also know that that's just too simple of a calculation, or in other words, I think the odds are very low that simple 8-month lag that we could have an exact repeat. But as we discussed today, we are seeing similar divergences today, as we saw in 2007, which is the high yield funds and the shoebox indicator are also diverging against the S&P, and the main component of the advanced decline line is not reflecting weakness at this time. Should the advanced decline line head south, I believe slow monies should make a portfolio allocation change. I wish all of you a happy and healthy 2014. I wanted to update you on these important conditions as we start out this new year. All the best, Chris.